Types of real estate investors equals real estate markets are extremely complicated. The price movements in this market are usually slow and difficult to come by. A major factor behind this is the type of investors who put their money in the real estate markets. Therefore, an understanding of the real estate markets has to be rooted in an understanding of the underlying participants as well as their motives. We will have a look at these factors in this article. Investment motive equals the most important feature based on which we can distinguish real estate investors is their investment motive. All investors buy real estate. However, not all of them do for the same reasons. Let's have a look at the three major categories of investors in the market. Speculators equals, these are the kinds of investors that should not be called investors in the first place. They give a bad name to real estate investing. This is because if you read their blogs and believe their claims, they will make a sophisticated operation like real estate investing sound like a no-brainer. These are the people that claim to have made $1 million in 4 years without any investment of their own simply by flipping real estate. The truth is that such results are almost never obtained. Real estate investment is an old-school investment game which only pays off in the long run. Most of these speculators are either people trying to make a quick buck by selling their phony, surefire real estate profit strategy, or people who have fallen prey to these con men and are actually trying these phony strategies in the market. This category of investors was hard to find just a few years ago. However, of late, they have become a lot more common. End users equals this is the most common category of investors that you will find in the real estate market. Usually people who buy real estate are buying their own homes. They have the intention of staying in the house for decades. This changes their outlook towards the investment. These people do not look at real estate as a purely financial decision. They look at it as a lifestyle choice. This is because they have to stay in that house day in and day out. Hence, factors such as lifestyle amenities available nearby as well as the distance it takes to commute to work become extremely important. The demand for these kinds of investors can be predicted based on where their job locations currently are or are expected to be in the near future. Long-term investors. Lastly, we have the long-term real estate investors. Like the flippers, these people too invest in the real estate market to make money. However, their decisions are not short-term. They understand that real estate is a slow-moving, a liquid kind of asset that steadily grows in value over a number of years. Many corporations are also present in the real estate investment business. Degree of control equals, the long-term investor category can be further subdivided into two more categories. These categories are distinguished based on the degree of control they exert on the property in question. Active investors equals some long-term investors prefer to manage the property themselves. They are the ones who conduct the repairs, find the tenants, and rent out their properties. Also, they may be actively involved in the property management process and may visit the property several times to ensure that no damage has been carried out by the tenants. Since they actively participate in the investing process, they are called active investors. Passive investors equals there are other long-term investors which have the ownership of the property. However, they do not take interest in managing its day-to-day affairs. To do so, they either hire employees or they end up hiring professional real estate management firms. Since they play no role in maintaining the property, they are called passive investors. They just provide the cash flow for financing the property and make very few, if any, decisions regarding its management. Legal entity equals lastly, the type of real estate investors can also be distinguished based on the type of legal entity they are. Legal entity is important because it determines the amount of liability that a person has. Individual investors equals most of the investors in the real estate market are individual investors. Individual investors have an unlimited liability. This means that if they undertake a mortgage on one house and default on it, their other assets can be liquidated to make good the loss. Institutional investors equals there are many institutional investors in the real estate market as well. These institutions usually finance themselves by issuing long-term bonds in the bond markets. Since these bonds have a secondary market, they are very liquid and provide the investors with the ability to enter and exit the real estate market without any major hassles. While, in terms of number, individual real estate investors may outnumber the institutional investors, in terms of scale or volume, they are no match for the big corporations who invest billions of dollars in real estate investments. Real estate market, like the other markets, is therefore complicated. It has various investor groups who have different motives, and based on the competition and cooperation between them, the real estate prices are set. Real estate investing myths equals amongst all investment options available, real estate is the one that buyers tend to get emotionally attached with. For this reason, people rationalize their emotional decisions with the help of many myths about real estate investing. If one wants to avoid getting entangled in the emotional aspects of real estate investing and make financially sound decisions, it is imperative that these real estate myths be recognized and dismissed. In this article, we will list down some of the foremost real estate investing myths and try to debunk them. Myth: land is scarce equals the most common myth propagated by real estate salesmen and other proponents of real estate investing is that land is scarce. There is only a limited amount of land in the world. This, coupled with the fact that the population of the world is increasing every day, gives credence to the conclusion that the land prices of the world will continue to rise perpetually since there will always be a shortage of land. However, a look at the numbers will explain that this is not the case. Firstly, it is true that there is a limited amount of land in the world. However, technological development is making it possible to make more efficient use of this land. Studies have been conducted in this area, and their conclusions state that even if the population of the world were to rise fourfold, there would still be an abundant amount of land for all humans to survive and thrive. Secondly, studies have also been conducted which state that the population of the world is about to stabilize. This means that the population growth era has reached its peak and now the number of people will remain more or less constant. Hence, the land is scarce and therefore precious logic is nothing but the propagation of a myth. Myth equals land prices always go up in value equals this logic is prevalent largely is developing economies which have witnessed unprecedented boom in the real estate sector in the past decade or so. The price of land in these economies has gone up 10 times in the past 2 decades. As a result, people in these countries have come to believe that the price of land always rises, i.e., the real estate always goes up in value. This is far from the truth, equals if one were to consider developed economies like Japan and the United States, one can find examples of real estate crashes where prices have dropped to the tune of 40% to 50%. In Japan, the prices have gone down and have continued to stay there for the better part of the last decade. Hence, once again, equals land prices always appreciate in value is a mythical statement. Land prices are connected to many factors, one of which is the well-being of an economy in general. Myth: past performance predicts future performance equals there is a common tendency amongst hopeful real estate investors to extrapolate the trends that were present in the property market in the past and create an extremely bullish future scenario. However, one needs to understand that the world has undergone a fundamental shift in the last decade or so. Business arrangements like outsourcing, free trade and cross-border investments by multinationals had created an unprecedented boom in the emerging economies. The future does not apparently hold any such revolution in its offing. In case no unexpected economic revolution fundamentally changes the economic paradigm, it is highly unlikely that the performance of the past few years gets repeated in the future years. Investors betting on a repeat performance are in for a rude shock. Myth: real estate investments can be flipped easily equals this is not a very popular myth. However, before the subprime crisis broke out in the United States, stories of self-made real estate millionaires who owe their fortunes to nothing but buying and selling real estate on borrowed money were common. These bloggers propagated the virtues of flipping, i.e., buying and selling real estate several times in a very short period. The idea was to book the profit arising from the price differential and converting it into cash. However, what these self-proclaimed gurus forgot to mention is the huge amount of transaction costs that are associated with any kind of real estate transaction worldwide. Therefore, the more properties you flip, the more transaction costs you incur. These transaction costs amount to anywhere between 2% to 5% of the price of the property in question. Apart from the transaction costs, finding a willing buyer and negotiating a deal is a tedious and time-consuming process. Flipping properties therefore causes immense drainage of time as well as resources, and therefore should be avoided as far as possible. Myth: buying is better than renting equals property buyers all over the world have an emotional connection with the real estate that they purchase. From traditional times, buying real estate has been considered the adult thing to do for a person. This decision has no financial backing and is rooted in the thinking that having a property to your name somehow makes one economically more secure. However, if we consider the financial aspects, this is clearly not true. There are some situations when buying is clearly the better thing to do, whereas there are other situations where renting is the best option. The ideal thing to do therefore depends on a case-to-case basis. This rent versus buy decision will be discussed in a later article. Real estate investments, as safe as houses? Investors usually refer to an extremely safe investment with the phrase as safe as houses. This shows the traditional mentality that real estate is one of the safest investment options. The old-school chain of thought believes that real estate investing is largely risk-free and provides the best hedge against inflation. However, the world has recently discovered after multiple real estate crashes that the houses aren't as safe as they were considered to be. This article enumerates the various risks that an investor has to face while investing in real estate properties. Some of the common risks are as follows. Risk number 1, risk of bad tenants equals a lot of people that invest in real estate usually invest for the sake of cash flows that are received from real estate. These cash flows are received in the form of steadily rising rental payments. The assumption behind these cash flows is that investors will always be able to find good tenants. Good tenants pay up on time, do not destroy property, and create no other legal hassles. However, research has shown that there is statistically a good chance that investors may not always find a good tenant. Bad tenants are rated as the number one risk by most seasoned real estate investors. Although only a very small percentage of investors will face bad tenants, there is a good chance that you may end up with significant legal costs if one comes your way. Hence, real estate investing is also a people's business. This is the reason why landlords want to look at credit scores and police records before they lease out their property. The idea is to mitigate these risks. Risk number 2, liquidity risks equals real estate investments are probably the most illiquid as compared to all other investments. This is because the amount of money required for real estate investments is huge and it takes a huge commitment from the personal finances of any investor. Therefore, in case you are a real estate investor and want to exit a property, there is no ready market which will provide minute-to-minute quotes regarding your property. Also, the buyers who are willing to enter into such a huge transaction are few and far between. Hence stocks, bonds, and gold can be liquidated in a few minutes if an investor has to. However, real estate takes a very long time to liquidate. This illiquidity needs to be priced into the real estate investment to ensure that investors are not making a bad bet. Risk number 3, leverage risks equals in the above point. We stated that real estate investments usually require a significant commitment of capital. Most people that buy real estate do not have that kind of spare capital to invest in a given property. Hence, over two-thirds of real estate that is bought and sold in any market have leverage attached to it. People usually buy a home with a mortgage. Equals the mortgage stretches over an extended period, let's say 30 years or so. Therefore, the interest that is due on the mortgage is several times the original amount borrowed. To add to that, the first few monthly payments that are made towards mortgage comprise almost exclusively of interest. Hence, over the first 4 years or so, one hardly pays back any principal. Since real estate is leveraged so highly, it almost exclusively relies on the property prices rising continuously. The property prices do not need to fall down. A mere stagnation would make the interest costs unsustainable and would take the investment in the red. Therefore, real estate investments are subject to some serious financing risks contrary to what is commonly believed by people. Risk number 4. Counterparty risks equals a lot of individuals that buy real estate usually buy unfinished units. Unfinished units are generally cheaper, and developers are willing to provide more favorable financing. However, buying under construction units also carries some serious risks. The investors become vulnerable to default by the developers. Also, many times the developers are unable to get the required permissions from the local authorities. As such, the project gets delayed. As a result of this delay, buyers end up losing a portion of their investment as they have to continue to pay rent. Thus, real estate investment projects are prone to counterparty risks. Investors need to be diligent and have a plan to mitigate such risks. Risk number 5. Information risks equals the real estate market is extremely opaque when compared to other markets. There is up-to-date and accurate information available in markets like stocks, bonds, and bullion. One can use the data to gauge the trends in the asset class and make informed decisions. However, when it comes to real estate, the only data that is available is from local brokers. These brokers have vested interests and therefore have no reason to provide reliable, actionable information. Data related to the ongoing rental and capital values is therefore largely a guess. Buyers, therefore, need to have multiple sources of information so that they can corroborate the validity of the data they receive. This risk has also been largely mitigated with the advent of online real estate portals and direct transactions between buyers and sellers. However, the price discovery mechanism remains largely opaque. Investing in real estate is a very sophisticated business that requires a lot of expertise to mitigate the risks that are mentioned above. Real estate and money supply equals there is a direct relationship between the amount of money supply that is available in the system and the amount of money that finds its way into the real estate market. This is because real estate is one of the most preferred investment classes in the world. It is considered to be a safe haven and one of the safest hedges against inflation. However, very few people are aware of the fact that real estate also ends up creating more money supply. This is because of the way the modern fractional reserve banking system works. The more real estate is created, the more mortgage loans are made and the higher the money supply goes. This recursive relationship between real estate and money supply, as well as how they propel each other higher, has been detailed in this article. Self-perpetuating money supply equals the modern system of real estate investing creates a situation wherein real estate catapults the money supply available in the system. This increased money supply then finds its way once again into the real estate sector. This never-ending back and forth between the banking system and the real estate system creates an environment of rising real estate prices. Since the fundamentals of the economy, i.e. income levels, are not changing, these rising prices are often a real estate bubble. This bubble bursts, bringing the prices down for a short period of time. However, in the long run, due to the very nature of the process, real estate investments end up propping up the money supply and creating a self-enforcing and amplifying loop. Mortgages create money equals about 80% of the house purchases across the developed nations in the world take place on borrowed money. Hence, the term house purchase can be considered to be synonymous with the word mortgage. This seems to be a normal thing until one considers how the modern banking system works. Banks do not lend out existing money, instead they create new money when they make loans. Therefore, whenever a bank makes a mortgage loan, it ends up creating that money and pumping it into the system. Therefore, the more mortgages there are, the more money there will be in the system. This fact can be easily empirically verified by comparing the growth of mortgage loans in the banking industry to the amount of money supply in the economy. The two charts almost move simultaneously. Money creates high inflation equals now. The problem with more money getting created is the fact that this newly created money revolves in the system. It derives its value by reducing the value of the other money in circulation. Therefore, in countries like the United States, when the mortgage markets were booming, there was extremely high inflation in the market. The high inflation, coupled with mediocre wages growth, creates a scenario wherein the workers are losing real wages. Inflation creates high prices equals the money that was created as a result of the mortgages finds its way largely into the real estate sector once again. This is because increasing demand for real estate takes the prices higher, causing buyers to queue up to buy what appear to be profitable investments. Now, excess money as well as excess demand in the system leads to the growth in the prices of real estate units. This further increases investor confidence that real estate is indeed an extremely profitable investment. The real estate prices, which initially appeared to be disproportionately high given the economic fundamentals, stay that way and the illusion begins to turn into reality. The inflated real estate prices become the new normal. Speculation creates more mortgages equals when speculators observe that some of their peers have made money by speculating on real estate, they too make an attempt to join the party. This further exerts an upward pressure on the real estate sector as excess money and excess demand now meet speculative intentions. This is the perfect recipe for a bubble. Speculators drive the prices sky high through self-reinforcing feedback loops. Higher prices in the past become the justification for even higher prices in the future. This period witnesses a rapid growth in mortgages as well as housing prices. The bust phase equals finally, at an unpredictable point in time, the bubble bursts. The primary reason behind the bust is the unsustainable economic condition in the economy. At this point in time, many borrowers are simply unable to make payments to their banks. As a result, the bank has to foreclose these homes and write down the losses. However, very few people know the fact that when banks write down these losses, they actually write the money out of existence. Since mortgages were what created the money in the first place, when these mortgages cease to exist, so does the money. As a result, the total money supply in the system is reduced, and as a result the prices appear to have gone down. Thus, mortgages and real estate prices have a huge influence on the money supply of the economy. Since money supply is one of the fundamental economic parameters, the real estate prices end up having a huge influence on the entire economy. Basic ratio analysis of real estate investing equals real estate investing is a sophisticated business. There are sophisticated techniques that are used by many diligent investors to carry out their due diligence. One such sophisticated technique is called ratio analysis. This technique is very similar to the ratio analysis that is carried out while evaluating the financial statements of publicly listed corporations. However, there are certain idiosyncrasies and terms that are used only in real estate investments that form a part of this ratio analysis too. This article explains the real estate investment-focused ratio analysis from an individual's point of view, i.e., what should one person look at when they focus on buying a rental property. Here are some of the most commonly used ratios. Loan-to-value ratio equals at an individual level. The loan-to-value, LTV, ratio is probably one of the most important number that is looked at by both banks as well as investors. Both these stakeholders look at the same number for very different reasons. For instance, the bank looks at the loan-to-value ratio for the purpose of the security of its own investment. Consider, for instance, a property with a loan-to-value ratio of 90%, i.e., if the value of the property is $100, then the bank has financed $90 and has a claim on the property. Now, if the value of the property falls down by 10%, the value of the bank's investment is still secure. The bank therefore provides better interest rates and other terms when the loan-to-value ratio is lower. Individuals also look at the loan-to-value ratio to find the degree of leverage that they are taking on while buying a property. A higher loan-to-value ratio signifies a risky investment, since even a small movement in the property prices would make the investment go in the red. Debt-to-income ratio equals. This ratio is used by individuals when they buy real estate for personal use, i.e., for personal consumption or investment. The debt-to-income ratio basically predicts the ease with which a person will be able to make mortgage loan payments. For instance, it is widely recognized that mortgage payments should form no more than 33% of a person's monthly income. If the mortgage payments are greater than 33%, then the person is at risk of falling under financial duress. This number is obtained by calculating the annual mortgage payments and then dividing the same by the person's net annual income. To convert the number into a percentage, we can multiply it by 100. If the number is greater than 33%, then the risk is high. Gross and net income multipliers equals. This number is used to calculate the amount of dollars that a person is paying as capital investment to gain control of an annual rental value. So, for instance, if this number is 18, then an investor is paying $18 upfront to gain control of an annual income of $1 in subsequent periods. This number is calculated by using the market value of the property in the numerator. In the denominator, one can use the gross rental income generated or the net rental income generated after subtracting all the taxes and expenses. If we use the gross income in the denominator, we get the gross income multiplier, whereas if we use the net income in the denominator, we get the net income multiplier. Rental yield equals. The rental yield is a number which is calculated like we calculate the bond yield in the bond markets. The annual rent generated by the property is used in the numerator. Usually, the gross rental value is used in the numerator and no deductions are carried out. However, there are no fixed rules to ratio calculations, and every investor calculates the ratios based on their own heuristics. In the denominator, the price paid for the property is used. Notice that the price paid for the property may be different from its current market value. An investor may have bought the property for $100 and now it may be worth $135. However, we will use the $100 figure. The reason behind this is simple. Yield can only be calculated once the value of your investment is considered. This is not a notional figure. Rather, it tells us the exact return on investment, ROI, that a buyer is currently obtaining on their property. Capitalization rate equals. The capitalization rate is similar to the rental yield number. However, there is one important difference. The rental yield uses the gross rental income in the numerator. However, the capitalization rate ratio uses the net income, i.e., the income that is generated after deducting all operating expenses and taxes from the rental income that is generated by the property. The denominator remains the same, i.e., the price that the investor has paid for the property. Once again, the price will not fluctuate based on the market value of the property, since this number is not a notional calculation of opportunity costs. Rather, it is the factual calculation of the return on investment on a given property. The list of ratios that can be used to evaluate a property can never be exhaustive. Ratio analysis is an art, and every individual investor uses it in a different way. However, as a general thumb rule, one must remember that real estate investing is largely a cash flow management business, and that investors must focus on their ability to generate and sustain predictably increasing cash flows. Transaction costs in the real estate market equals flipping properties may sound like a good idea to the novice real estate investor. However, anyone who has even engaged in real estate transactions even once or twice knows that there are significant costs associated with real estate transactions. These costs are called transaction costs because they are triggered when a real estate transaction takes place. These costs tend to be significant and have the potential to burn a hole in your budget if they are not accounted for well in advance. In this article, we have listed down some of the common transaction costs. This list is not exhaustive as transaction costs can vary depending on when and where the transaction is taking place. However, they do provide a good understanding of the types of costs that one can expect to incur. Brokerage equals brokerage is one of the most known costs associated with real estate transactions. This cost is typically a charge by a broker. The job of the broker is to make the buyer and the seller meet. The broker also has to assist during the period of negotiations and convey the offers and counter-offers between the buyers and sellers. The broker has to ensure that both the buyer and the seller are on the same page. To do so, they charge a fixed percentage of the transaction value from both the parties. This model of charging a percentage value from both the parties has come under criticism. This is because this model creates a misalignment between the incentives of the principals to the party and the agent. Since the broker's compensation is a percentage of the transaction value, the broker has an incentive to maximize the transaction value to maximize their gain. Search costs equals search costs are another commonly known cost that are associated with real estate investing. These costs include money paid to newspapers and magazines to advertise the property. Nowadays, online portals allow sellers to advertise their properties for free. However, serious sellers use the premium paid services offered by these websites. Hence, there may be a cost attached with that too. Apart from that, if the owner of the house wants to rent the property instead of selling it, there may be costs associated with conducting a credit check of the potential tenant to determine the credit worthiness of the potential tenant. Apart from that, from the buyer's point of view, visits have to be scheduled to various houses. These visits cost time as well as money and add to the search costs from the buyer's point of view. Legal and administrative costs equals the real estate business requires extensive paperwork. This is because the costs of real estate are extremely high. Therefore, when any person transacts, i.e. buys or sells real estate, they want to ensure that the deal, which has been agreed on in person, also finds its way to an agreement in black and white. As such, attorneys and lawyers have to be engaged in the process. In fact, real estate transactions tend to be complicated. This is the reason that there are attorneys that specialize in real estate laws. Also, there are administrative costs involved with the transfer of title for utilities such as water, electricity, cable, etc. These transfers take a small but significant amount of time and money too. Statutory costs equals across the world. Whenever real estate transactions take place, the government usually adds to the transaction costs by taking a portion of the sale proceeds. Across the United Kingdom, Australia, India, and in some states in the United States, a stamp duty is levied on the transaction value. Thus, if the transaction was completed for $100, then $3 is owed to the government for the transaction to be considered legally valid. This often results in people undervaluing their transactions on paper and offering black money to the seller, thereby reducing the amount of stamp duty payable. In many other countries, conveyance of the property title needs to be done by the government. As such, the government charges a hefty conveyance fee. Also, many jurisdictions charge another tax, called the ad valorem tax, when real estate transactions take place. This obviously is another form of transaction costs being charged by the government. The statutory costs of real estate transactions are huge and the most visible component of the expenses incurred during the period. As such, they are also the biggest deterrent to buyers and sellers as they make flipping properties difficult as well as expensive. Financing costs equals most of the housing transactions that are conducted nowadays are financed using borrowed money. As a result, there are some transaction charges that need to be paid to the lender as well. Consider for instance, the processing fee that is charged by most lenders to process the mortgage agreement. This charge is also a substantial sum, usually accounting for 0.15% to 0.25% of the property value. This is the fee charged by lenders for the cost of collecting your documents and running a credit check on them to determine your creditworthiness. Also, this covers the charge of the procedure of loan disbursement that needs to be followed. Apart from the lenders also charge various fees to verify the title of the property in question and for a variety of other services that they provide. The costs of transacting in real estate are many and varied. This is what makes real estate investment a long-term game. Flipping houses like one can flip stocks or bonds is simply not possible because of the complexity of the transaction costs involved. Information asymmetry in the real estate market equals successful investors know that it is not the asset class that makes one rich. Rather, it is information about the asset class that makes one rich. Therefore, if any investor were to consistently have access to information which is not available in the market, they could trade off of it and gain a handsome return in the process. The real estate market has one of the most opaque information systems. Relevant information is not publicly dispersed through official sources. Rather, it spreads via grapevine. Therefore, one needs to be well connected to obtain such information and benefit from it. In this article, we have listed the various levels of information that buyers can expect to have. Level 0 information, publicly available equals the real estate market does not have near perfect information systems like the stock market or the bond market. This is partly due to the diverse nature of the commodity being traded. The stock and bond markets sell homogeneous and standard commodities and as a result can report information which is accurate and enables decision-making. On the other hand, real estate is diverse. Buyers have to consider a wide variety of factors such as location, proximity to daily amenities, neighborhood profile, and so on. As a result, the publicly available information is imperfect. For instance, if you were to inquire about the prices of property in a completely new neighborhood, odds are that the online and newspaper advertisements will quote a higher price. As you dig deeper into the market and become more familiar with it, you may be able to obtain a better price. To sum it up, the price discovery mechanism in real estate markets is not efficient. As a result, the publicly available information is not very useful when it comes to decision-making. Level 1 information, hands-on information equals the next level of information is obtained when a buyer actually visits the micro-market that he/she is interested in buying a property in. Newspapers and magazines can provide you with a base rate or a range within which the prices should ideally lie. This information is obtained by talking to people who have actually been involved in such deals in the recent past. They can provide a best estimate of the condition of the market as well as the sentiment of buyers and sellers. This information is more valuable than the one which is available through impersonal mediums such as net surfing. As such, more effort has to be spent in collecting it. Level 2 information, available with mediators equals the next level of information is available with the mediators in the market. A buyer can only gather a certain level of information even if he/she visits the micro-market on a regular basis before closing in on the deal. This is because they will not be able to witness the closing of multiple deals in the neighborhood. The deals that are initially floated in the media are very different from the deals which actually go through after negotiations. The mediators have access to both these types of information. They know the details of the advertisements that are displayed in the newspaper as well as the real deals which. Level 3 information, available with bureaucrats equals at this stage, we are not talking about information that already exists in the market. Instead, we are talking about future information that may have an effect on the economic value of the property. This may include information such as future development plans or infrastructure plans in and around the neighborhood. For instance, if a new airport were being constructed 5 miles away from your property, it would definitely bring more appreciation to you. This kind of information is not available with the general population. However, lawmakers and bureaucrats do have access to this information before it is made public. After all, they are the ones that are making these laws. Hence, it is likely that these people who have an unfair information advantage can use this information to their benefit. This usually happens as bureaucrats and lawmakers pass this information on to their cronies. The cronies then buy up land at the prevailing prices, and soon when the information has been made public, they sell their land, and the cronies as well as their principal end up making a handsome return. This kind of information is also called insider information. If it were proved that a person was investing on the basis of such information or even had access to such information, they could be looking at time in prison. Thus, there are various levels of information available in the market. The amount of money that an investor puts in the market as well as the amount of risk that is taken should largely depend on the kind of information that is available. The better the information, the more risk can be taken without suffering too many adverse consequences. The true cost of owning a property equals home ownership is often considered by the layman as being a single expense, i.e., the purchase price of the property. However, if we were to truly analyze the situation, home ownership consists of several expenses. It is easy to forget about some of the expenses while budgeting. Therefore, in this article, we have prepared a checklist of some of the expenses that usually arise in such scenarios. Some of the investments are as follows. Purchase price equals this is the most obvious cost that is associated with real estate investing. Therefore, if we buy a $100,000 home, we think that we have invested only that amount. When people ask, "How much did you buy it for?" we give the above figure as the answer. However, as we shall discover in the course of this article, that the layman's viewpoint that $100,000 is the complete cost of the property is usually incorrect. To begin with, there are transaction costs that are associated with the purchase. The transaction costs include brokerage paid, processing fees paid to the bank to process the mortgage loan, as well as the legal charges that are collected by the government to register the property in the name of the new buyer. First-time buyers have a tendency to underestimate these expenses. However, they can quickly climb up to anywhere between 3% and 5% of the property value. Thus, even if the list price of the property is $100,000, the actual price paid by the buyer will be at least $105,000. Interest paid equals most properties that are purchased today are purchased using borrowed money. Mortgage is the new norm. People buying properties with cash down are virtually unheard of today. However, whenever there is a mortgage, there are mortgage payments, and mortgage payments also include an interest component. The amortization schedule of any mortgage is such that the banks collect all the interest first and then later collect the principal outstanding. For instance, if your monthly payment is $1,000, then in the first few months, $900 will go towards interest itself. In fact, during the first 5 years of servicing a mortgage loan, the borrowers are servicing the interest payments only. Very little principal is reduced during this period. Hence, if these expenses are capitalized, i.e., added to the value of the property, then the value of $100,000 goes way above $100,000. Notional interest equals, apart from the interest paid, which is an out-of-pocket expense for the buyers, there is also notional interest involved in case of real estate investing. Most real estate investments require the buyer to put a down payment on the property. This down payment is close to 10% to 15% of the property value. Thus, for a $100,000, a person has to offer an upfront payment of $15,000. Now, there is an opportunity cost in making this payment. If this money was not used to make the down payment, then it would be earning interest in a bank or in some other investment. However, once it is used to make the down payment, it earns no interest. Therefore, the amount of notional interest lost should also be added to the property value, i.e., to the $100,000 that the buyer initially considered was their total investment in the property. Insurance equals most mortgage lenders require the buyer to have insurance on the property. This is because in the event of natural disasters like earthquakes and hurricanes, the property could be destroyed. As such, the borrower will simply stop making payments towards the property. Therefore, in order to protect their interests, the lenders insist on insurance. Even apart from the insurance which covers the value of the house, many homeowners opt for insurance for home contents as well. This is because they spend a significant amount of money doing interiors as well as need to make sure that their investment is protected in the event of an unforeseen scenario. This too adds to the cost of property ownership. Property taxes equals when we buy real estate, we agree to make a stream of payments to the government every year until perpetuity. These payments are called property taxes, and almost every government in the world levies these taxes. Once again, these taxes contribute significantly to the cost of home ownership. Also, one needs to understand that these costs are often adjusted in value over time. Therefore, these costs rise with inflation often at the same rate. Hence, while budgeting for buying property, one must take into account the costs involved. Maintenance equals properties across the world now come with amenities. Gated communities with swimming pools and jogging tracks are common. The idea is to provide the people with a lifestyle and not merely with a home. However, these amenities require a lot of maintenance. Gated communities require scores of employees and equipment to guard the place and keep it clean. As such, these charges are also billed to the homebuyers as a monthly expense. This too raises the cost of investment in a property. These costs can sneak up on an unsuspecting buyer, and therefore one needs to be extremely wary of the same. Utilities and furniture equals there are small costs involved with getting the utilities transferred to one's name as well as furnishing the house. These costs too add to the total cost of home ownership. Home ownership is therefore a complex maze of multiple costs. One needs to be very careful in understanding and budgeting for these hidden expenses, as omission of these expenses can significantly dent your budget in the future. Behavioral aspects. Real estate investing equals investments are supposed to be financial decisions. When we take finance classes, we are taught models to evaluate investments and base our decisions on. However, in real life, people take investment decisions emotionally. This is truer of real estate investments. Most people are emotionally attached to their homes or the idea of a home. Hence, they make decisions based on a lot of parameters which are not exactly financial or mathematical. In this article, we will list down some of the behavioral motives behind real estate decision-making. Buying a property as a rite of passage equals a property is an emotional investment for most people. This is even more valid for young people. Individuals as well as couples in the late 20s and early 30s form one of the fastest growing segments of home buyers. These are people who are newly married or are about to be married. The primary reason that they buy a house is because they believe that buying a house is a rite of passage onto adulthood. They have seen their parents and their grandparents buy a house the moment they were married and equate the act of buying a house with starting a family. The act of buying a house, therefore, becomes a rite of passage to family life. Developers are fully aware of this tendency of the buyers and therefore design entire marketing campaigns to stimulate these emotions. However, successful real estate investors know that investing is after all a monetary affair. Mixing family emotions in the process only complicates it and leads to bad investment decisions. Buying a property because everybody else does equals for many people buying a property is a symbol of economic prosperity. When they move out of college and have a relatively stable job, one of the first things that they do is get themselves a mortgage and buy a property. This is because once again emotions are at play in this investment decisions. They equate the decision of buying a house with the public declaration that they have succeeded in life. The house is thus a symbol of success. Developers once again have realized this tendency. Therefore, they have built many suburban homes for middle-class families with opulent amenities. The idea is to give the middle-class buyer an aspirational feel of success and validate their emotional decision that they have indeed become successful. Buying a property because someone earned millions in the past equals the past couple of decades have witnessed a real estate boom in most parts of the world barring a few. Therefore, stories of people who had nothing and suddenly became millionaires because of the vast tracts of land that they owned suddenly became very valuable is common. As more and more urbanization has taken place, people who owned large tracts of farmland have suddenly become very wealthy. This has given rise to another class of wannabe investors who want to repeat the process. There is one major difference. They expect the real estate price appreciation to continue at the same rate that it has done in the past. Anyone familiar with real estate or economics in general will tell you that exponential growth at high rates cannot continue for a very long time. The general outlook towards the real estate sector world over is bearish. However, the emotion of greed in these investors makes them believe that the markets will continue to rise endlessly. Therefore, their decisions are not based on sound financial analysis. Rather, they are based on emotions and the adrenaline rush that the idea of making a lot of money in a short time provides them. Buying a property because of tax advantages equals another rationalization that a lot of middle-class buyers use for buying homes is tax advantages. Governments all over the world offer tax breaks for buying a home. They allow the borrower to deduct a portion of the amount that they have paid as interest and capital towards their mortgage from the income, thereby reducing the income and the tax owed. This makes investing in real estate seem like a good idea. This is because it does provide some upside in the form of possible capital appreciation and cash flows. On top of that, it allows investors to save money because of a reduced tax bill. This is not the case in reality. The tax breaks offered by the government are minimal as compared to the interest that one ends up paying on a mortgage. Thus, if we look at it financially, buying a home may not be a viable decision. However, emotionally, the perceived tax breaks seem to make sense to a lot of investors. Buying a property because land is scarce. Lastly, developers monger on the fear of the common public that land is scarce and the population of the world is rapidly growing. Thus, falling supply and rising demand ought to bring about an appreciation. This argument is flawed on several counts. Firstly, even with the massive population growth, there is enough land in the world to house all the people, and this can be done several times over. So we are nowhere even close to a supply crisis. On top of that, the demand for real estate will not grow at the rate that it has because the population of the world has stabilized in the past few years. Therefore, buying land because there won't be any left to buy in the future is an incorrect argument. Real estate investing versus investing for cash flows equals different types of investors invest in real estate for various reasons. Two of the most common reasons are investing to generate a steady stream of income, i.e. cash flows, and investing to make a quick buck because of the price rise in the market. This article compares both these approaches and the risks and rewards inherent in them. Investing for capital gains versus investing for cash flow equals predictability. Investing for cash flow has the advantage of being a lot more predictable as compared to investing for capital gain. Buyers who invest for capital gain have very little realistic basis to predict the profits that they expect to make. A lot of these buyers believe that the macroeconomic fundamentals of the economy will ensure that the prices continue to rise perpetually. This is not, and will not be true of any economy. Real estate industry, like any industry, faces cycles of escalating and falling housing prices. Some other home buyers simply believe in the greater fool theory. They simply expect that they will find someone else who will be willing to buy the property from them at an even more inflated price, hoping to repeat the same feat that they have accomplished. Therefore, investing for capital gains is largely a buy and hold strategy. Investing for cash flow, on the other hand, has the component of predictability. Investors who invest for capital gain have a reasonable idea of the events that are about to unfold. Therefore, they can predict, with a fair deal of certainty, the amount of profit expected on a periodic as well as a long-term basis. Sustainability equals investing for cash flows is more sustainable as compared to investing for capital gains. This is because a cash flow-based strategy is grounded in reality. There is cash coming in every month. The cash may be more or less than expected. However, in a well-structured deal, there is enough cash to at least cover the operating expenses. This makes the property self-sustaining, as it can continue to function without any financial support from the investor. This gives the investors more flexibility to manage these properties even when the markets depict a bearish trend. Properties purchased with an intention of capital gain are markedly different from this. These properties bleed red ink from the very first day. The investors are expected to pump in more and more money during the duration of the property investment. There is a cash inflow only when the investment is terminated, i.e., when the property is sold. Hence, if a favorable exit point does not come, investors may run out of cash required to sustain the profit and may have to sell the property at whatever price is being quoted in the market. Such distressed sales make investing for capital gains an unviable proposition. Tax efficient equals investing for cash flows is far more tax efficient than investing for capital gains. The capital gain laws in most countries make it impossible to flip properties without incurring a serious loss in the form of taxation. Rental income, which forms the core of any strategy based on cash flow, has significant tax advantages. Investors are allowed to deduct a wide range of expenses from the rental income. Therefore, they can significantly lower their income and pay lowered taxes based on their lowered income. Also, since rental income accrues over many years, it gets spread out and hence is taxed at a lower rate. On the other hand, capital gains appear in one shot as an income. This takes the income of the investor in a higher tax bracket, and as such they are taxed at a higher rate. There are some deductions available when investors book capital gains from a given property. However, these deductions are nowhere as efficient in reducing income as compared to deductions available when the property is rented out. Riskiness equals, if we simply define risk as a measure of deviation from the norm, investing for capital gains is far more risky as compared to investing for cash flows. Capital values tend to fluctuate a lot in the real estate sector. However, if we look at the rental values, they show a predictable appreciation of 8% to 10% per year. Therefore, there is less volatility in the rental market. Any investment that is made based on cash flow projections of the rental market is less risky as compared to investments made based on future capital values. Also, investors have a higher degree of control over the rental values than they have on the capital values. Investors can make property improvements and significantly improve the rental prospects of a given property. The same cannot be said regarding the capital value of a given property. Opportunities in bear markets equals properties which produce positive cash flows are not easily available. They are certainly not advertised on the first page of your daily newspaper. These properties are found after hunting for a bargain for a significant amount of time. Also, these bargains are found in bear markets such as the one that was present in 2008 subprime crisis. During this period, more and more people face foreclosure. Therefore, these people do not have homes as their homes are being sold in the market for cheap. On the other hand, these families want to rent apartments so that they can live in them. Therefore, the rental values remain strong or even go up despite depreciating capital values. It is in such rare times that sophisticated real estate investors ensure that they have the cash on hand to make deals and buy properties which provide a predictable stream of cash flow to the buyers. Real estate investment trusts, REITs, equals real estate investment trusts, REITs, have become the buzzword when it comes to investing in real estate. They have provided above-average returns in countries like the United States, where they were first implemented. This has led to the growing popularity of the real estate investment trusts, REITs, and today more countries in the world are adopting this investment structure. In this article, we will explain in detail what real estate investment trusts, REITs, means and why they provide a more beneficial way to invest in real estate than other legal structures. Concept of real estate investment trusts, REITs, equals about 5 decades ago. The concept of real estate investment trusts, REITs, was first introduced in the United States. Ever since, this idea has grown tremendously in terms of market acceptance. REITs have gone from being an alternative investment class to being an investment class that has become the choice of the majority. The concept of REITs is simple. Just like a mutual fund allows investors to benefit from diversification and professional expertise of the fund managers, so do these trusts. These trusts pool in the money collected from a lot of investors. Then they use money from this pool to invest long-term in properties. However, the individual investor need not be in for a long-term investment. Real estate investment trusts, REITs, have a secondary market. Therefore, any individual investor can sell their share of the investment to other investors in the market at the ongoing price. Since prices for shares of real estate investment trusts are quoted on a real-time basis, these trusts provide the individual investor with much-needed liquidity that is usually absent when one makes real estate investments. Buying real estate investment trusts, REITs, is buying a business equals REITs invest the money that they have collected in real estate. However, it would be incorrect to assume that real estate investment trusts are nothing more than a vehicle for secondary investments in realty. In reality, investing in real estate investment trusts, REITs, is like investing in a business. This means that if two real estate investment trusts are given the exact same amount of money, they will end up making very different returns based on how they are managed. In fact, if they are given the exact same properties to manage, the returns would still be pretty different. Hence, the returns provided by real estate investment trusts, REITs, depend more on their management expertise and style than other factors. Therefore, buying a share in real estate investment trusts, REITs, is equivalent to buying shares in a business. History equals real estate investment trusts started in 1960s in the United States, wherein they were amateur investments. President Eisenhower had signed the REIT Act into existence. The idea was to provide the average investor the benefit of investing in commercial properties. Prior to REITs, such investments were only available to huge financial institutions and extremely wealthy individuals. With the advent of REITs, the masses could now have access to the same investments. The idea of real estate investment trusts, REITs, became extremely popular in the United States as multiple legislations were created in the future to enable efficient functioning of these trusts. The idea then became so successful that today it has spread worldwide. Many countries such as Malaysia, Australia, Hong Kong, and even developing nations like Ghana have embraced the concept of real estate investment trusts. Specialization equals one of the biggest changes that have happened in the real estate investment trusts, REITs, space is that the industry has become highly specialized. When the industry first came into existence, the trust would buy pretty much any property that they could get their hands on. For instance, they would buy commercial office space, malls, and even multi-property residential homes. However, over time, the industry realized that the risk-reward profiles of each of these investments are different. As such, companies started specializing in one of these property types. Today, most real estate investment trusts, REITs, will exclusively state the type of property that they invest in and the risk-rewards that accrue as a result in their investment brochure. Investors therefore have more control over where their money is being invested. Future equals at the present moment, the short-term future of the real estate investment trusts, REITs, is considered to be negative. This is because the Fed is about to announce its QE tapering program. QE tapering is expected to hit all asset classes. However, one of the worst hit is going to be real estate. After all, real estate has been the source at which the entire crisis, which led to QE and QE tapering, started. The real estate investment trusts, REITs, are therefore expected to see a period of turmoil in the forthcoming years. However, the long-term outlook on real estate seems good. Since real estate investment trusts are one of the best ways to invest in real estate, the long-term outlook on REITs seems good by extension.